Uh, Good evening. Good evening, everyone at the GLIIF program. We are out
Good
with
evening,
our
ma'am.
series of webinars, and we welcome all of you here. Just to remind you that we are all part of the Global Links Impact Investment Forum, and today we have with us an expert in the field of impact investment and a professor from USA talking to my colleagues, my students, and all those who belong to the GLIIF family. So Global Links Impact Investment Forum welcomes you all, and with a special regard and welcome to Professor Koray D. Simsek. I have the honor of introducing Professor Koray D. Simsek. He's a PhD and CFA as an associate professor of finance at Rollins College, Crummer Graduate School of Business in Florida, USA. His research focuses on investments, risk management, and derivative markets. Dr. Simsek has also been a visiting scholar at MIT Sloan School of Management. Besides his CFA degree, he has been volunteering with the CFA Institute also. Dr. Simsek's research has been published in academic and practitioner journals in finance as well as cross-disciplinary fields. Dr. Simsek earned his BSc in Industrial Engineering from Boğaziçi University in Istanbul, Turkey in 2000 and PhD in Operations Research and Financial Engineering from Princeton University in 2004. Dr. Simsek has served as a consultant or instructor for various companies and organizations in asset management, banking, energy, and financial technology industries. Among these are Akbank, Borsa, Istanbul, Infina, İşbank, Rasionet in Turkey, EDF and Lixor in France, and the Department of Labor and Mount Lucas Management in the US. Dr. Simsek's interest in the area of sustainable investment peaked when he served as a moderator in the 2004 Sustainability Index Istanbul workshop, which has helped Borsa Istanbul in developing its sustainability index. He currently serves as the faculty advisor for Crummer's Student Managed Investment Fund, which uses ESG, that is environmental social governance investing, as an overlay theme. So we welcome Professor Koray to our webinar, and we look forward to a very, very enriching evening here with us. Dr. Koray.
Thank you so much for that introduction, Professor Sharmista. I'm really delighted to be here sharing what I know or some of the things that I've been reading about, really one of my favorite topics to read about. There's so much research, there is so much being written about this very important topic of impact investing. And again, I'm delighted to share these with all the stakeholders of Global Links Impact Investment Forum. What I would like to talk about today is basically, I'm going to help all of us scratch the surface a little bit of this very important, timely, and quickly growing area in the world of investing. So I'm going to walk you over a few definitions for impact investing, some comparisons with other types of investing, and then I'm going to share with you a few ways of measuring impact investing, measuring the size and the growth of the market, measuring the performance, and other types of details. And then finally, I would like to kind of wrap up our discussion with why now? Why is such a significant growth? Why is such a big interest in the world of impact investing? So with that, let me begin with, this is probably a professor's habit. We start with definitions. So I would like to start with a definition for impact investing. And one of my favorite definitions is actually from a very important resource. And again, if we have time at the end of the webinar, I'd like to share some resources with you in terms of the websites to follow, the organizations to follow, scholars to follow in this important area. GEIN, the Global Impact Investing Network, has this definition for impact investing. It says, in investing with the intention to generate positive, measurable, non-financial impact alongside a financial return. I highlighted or made bold a few terms here. It's not really in bold in their original definition, but I think these are very important, and we should probably recognize these as core components of this definition. So there's a clear intention for impact. So investors following this investment theme have definitely intention to do this or generate this impact. But that intent doesn't stop there. They want to measure that impact as well. But at the same time, they have this dual objective too. So generating a financial return is still there as the nature of the word investment. Those three core components of this definition are very important, obviously, but the word impact shouldn't be overlooked. That's in the name of the concept as well. So what do we mean by non-financial impact, really? What are various dimensions of it, or categories that should be considered, or that investors considered in impact investing? So you're going to see three letters that are in red here, and those are the initials of the three important categories of impact investing: environmental, social, and governance, or corporate governance. And you would, in most resources, you would see that there's an explicit focus on environmental and social, but make no mistake, the way that many impact investors try to make an impact through their investments actually help with the governance of the enterprises that they invest in as well. So that's almost like a hidden dimension alongside the other two very important dimensions, the environmental and social dimensions of impact. And I wanted to point this out because often you hear this buzzword in the mainstream media or financial news media of this concept called ESG. Again, those initials are for environmental, social, and governance. And ESG investing, which started almost like a buzzword, is now everywhere in the world of finance. And it's so big that you're going to see in my talk today, I am going to back and forth between ESG investing and impact investing, because in many respects, you will see that impact investing is encompassed by this ESG investing framework, because you will see that many stakeholders and many organizations interested in impact investing actually position themselves or the idea of impact investing in the spectrum of ESG investing. So this general framework that we now call commonly ESG investing is important to understand for us to really recognize the nature of impact investing. So that's why I wanted to point this out. I'll share some comparisons now with between impact investing and traditional investing. You know, as a CFA holder, one of my favorite resources to follow is the Financial Analysts Journal, that one of the top practitioner journals in the field. And one of the most recent articles, actually, that appeared in this journal tries to position impact investing vis-a-vis traditional investing. And in terms of the objectives of these two investment themes, you would see that traditional investing is really focused on the investment returns, the financial returns. So making money is the objective there. It's the primary objective, in most cases, the only objective. In impact investing, you have these dual objective investors who are interested in both making money, but also they're interested in doing good. And when they do so, when they're interested in doing good, that means they're interested in non-financial impact. Now, it doesn't mean that traditional investing has no non-financial impact. These types of investing may have positive or negative non-financial impacts on environment, social impact, or governance-related impacts. But these investors, these traditional investors, really do not seek to have or to generate a non-financial impact, but their traditional investments may have positive or negative impacts as a side effect. Whereas if you look at impact investing, you would see that the focus is really to have an intention on having an impact. So doing good or generating an environmental, social, or governance-related non-financial impact is intentionally sought after. And that intention just doesn't stop there at the intentional level. So we intend to have this impact and we stop thinking about it. No, in impact investing, the investors measure their impact and they anticipate, they plan for an impact. So that measurement part, I think, is very critical because you don't see that obviously in traditional investing. I mean, they don't really recognize that and they don't try to measure that. Now, because impact investors care about that measurement, it's even more important for enterprises seeking to get together, join with impact investors, recognize this important aspect, and they should understand how they're being measured. And they should measure up to those frameworks that impact investors use. So if I have time, I would like to talk about a few of those as well. So this is not really one of my favorite slides to have because there are really tiny pieces of text on it, but I like this a lot. This is from Impact Management Project. And the CFA Institute came out with a white paper that actually put this chart in that white paper. So I basically wanted to share this exhibit with you from that publication because it really not only compares the traditional investments with impact investments, but it also shows you the full gamut, the full spectrum of investors, all the way from the traditional investors up to those interested in philanthropy who are really not interested so much in any financial goals. Of course, philanthropists are interested in, seeing a good use of the capital that they provided, but they're not really, in a majority of the cases, asking for anything in return. Now here, to the left-hand side of the spectrum, you would see those investors who really seek returns. So they seek positive returns. But impact investors, some of them can be different because they may accept lower risk-adjusted returns. So they don't necessarily ask for returns that would match the market returns. They're okay with sacrificing some of the returns as long as they're positive, so they can actually do another round of investment in the future. But they are interested in these impact goals. And again, on my previous slide, I said that traditional investors don't consider these. But then you would see these other types of investors who are not necessarily impact investors, but they're still in the ESG investing spectrum. So this middle, the responsible investors, the sustainable investors, the impact-driven investors, they are different versions of these ESG investors. And that's why I really like this methodology that Impact Management Project came up with. It's like the ABCs of impact driven or impact goal, dual objective driven investors, the ESG investors in general. The A is those who try to avoid harm with their investments. And we typically call these investors in the finance world, and on the next slide, I'm going to refer to them as well, the exclusionary investors, the negative screening investors. And B is those investors who really seek to have a sustainable type of investing to generate positive outcomes for people or the planet. And they are again, the sustainable investors or the ESG oriented investors, tilting their investments towards an ESG objective. And finally, impact-driven investors want to see that solutions are generated for the world's problems or problems that the underserved people are facing. So they want to directly contribute to those solutions. So that's how they're different compared to the other types of ESG investors, which probably I should now at this point give a few examples for using another type of matrix, if you will. And again, this is from a journal that just started its journey just last year, and that you can see how this topic is getting even more and more important. There is a journal dedicated to impact and ESG investing now, and the editor of this journal, Brian Bruce, in his inaugural issue, wrote a very brief but very good commentary and tried to kind of explain it along these three types of investors: those who have alignment or exclusionary screening goals, those who have sustainability or ESG integration goals, and those who have impact investing goals. And then remember those three letters, the ESG, and the environmental, social, and governance dimensions. And he gave a few examples to every one of these the flavors of ESG investing, including impact investing, along the lines of these categories or these objectives: the environmental objectives, social objectives, and governance objectives. I'm not going to go into the details up here because our topic is impact investing, but I'd like to focus on the bottom here. So how do these impact investors, for instance, if they have an environmental objective in mind, what do? So impact investors target investing in clean technologies. Those technologies that do not cause pollution when power, electricity, energy is being generated, they specifically target those investments, and that's how they actually align their environmental objective with their impact investing goal. Social objectives that would help elevate the social norms and fix the problems that we have in our society. The micro lending is a very good example for that type of impact investing. Investing in social ventures and enterprises is yet another example. And you can really see that happening with that type of impact investing. And finally, as I said before, most people only focus on environmental and social dimensions of impact investing, but impact investors can have governance impact as well. And how does that work? Well, many impact investors say, well, if I invest in your enterprise, I want to engage with you, have a hands-on approach. And that engagement can take many forms, and we typically cluster them under this thing called corporate governance engagement programs, but it can very well be something like the private equity funds do, right? Well, I will invest in your enterprise, but I also want to sit on the board or help the management to actually elevate the enterprise to a higher level. So we see that those investors have an impact not only in the particular sector that enterprise is operating in, so they have an impact there, but they also have an impact on the governance of the enterprise as well. So that's very powerful. With that, I also would like to point out that these types of frameworks are really helpful in understanding impact investors. And I've already mentioned an example from them before with that big chart, big exhibit. The impact management project has actually a framework to help impact investors to identify in what dimensions, what layers they actually are contributing to the impact that the enterprise, the firm, the organization that they're investing in will be making. And this is important because this actually is a start of how they measure the impact, how the investors measure the impact, right? So if we understand these dimensions, that helps us understand the mindset of the impact investors too. So what are these things? So by simply providing capital, impact investors they give a signal to the other firms out there, the other enterprises out there, that impact does matter. I'm investing in these ventures, these initiatives, because of their impact, not only because of the financial returns. A second contribution that impact investors make is they, again, as I explained it in the governance dimension, they engage with the enterprises they fund actively. That active engagement is very important. Another dimension is when there's an underserved population, a market that has not been really developed and needs development, but other investors thought that, well, that would not create sufficient risk-adjusted return. There's a lot of risk there. These investors put that risk discussion on the back seat, and they focus on growing these new and undersupplied markets. And finally, again, not all impact investors have above market return or a market return expectations. Some of them are able to provide flexible capital with below market return expectations. Some of them provide capital with just preservation of capital. So no returns, just provide the capital back. This is and these are not mutually exclusive. So you may see venture capitalists that actually target all four of these dimensions. This is probably not only true in developed markets, but also in emerging markets as well. And I'm going to provide some numbers along the way. So financial performance, right? I said that it is still important because these are dual objective investors. What does the research say about financial performance of impact investing? I'm not going to go into the details, but I'm going to provide a few insights. The results are mixed. There are some studies that find impact investing actually doesn't sacrifice returns, and on average, they may provide market returns. But then there are some studies, like a very recent study from Barber, Morse, and Yasuda, that say, especially private equity or venture capital type of investments are more likely to provide below market returns. Now, is that a bad thing? It turns out not necessarily, because those investors are actually willing to accept these below market returns. They're aware of it, and their willingness to pay for the impact that they're making is along their expectations. So as long as investor expectations are met, this below market performance is not a harmful thing or detrimental to the reputation of the impact investing domain. And it turns out, in the Global Impact Investing Network, with their surveys, found that On the private debt side, actually, impact investment returns are quite stable and on average also align really well and even better than the private equity returns with investor expectations. So how large is this market now? How large is impact investing? And you will see many different numbers out there. It's not very easy to measure the size of these markets. One measure provided by the Global Impact Investing Network is roughly $700 billion, a little bit more than $700 billion. Now, of course, that doesn't give a lot of perspective as a single number, but that's an annual growth over the previous year by 50%. So there's huge growth, a huge cash flowing into this type of investing. And again, as I said, ESG investing, the more general framework is also analyzed quite regularly now, and BlackRock, the world's largest asset manager, surveyed globally, not only in the US, but globally, asset managers, investors who are managing around $25 trillion in assets. And they say 18% of their assets, which is roughly 5 trillion, 4.5 trillion of their assets are already in sustainable investing. In other words, not necessarily impact, but impact, sustainable, and other types of ESG investing. And their target is going up to 37% by 2025. This is, again, huge growth. Another measurement of the market just for US says all those assets under management in US domiciled investors with sustainable investing strategies is around $17.5 trillion. And how big is that for the United States? That's like a third of all the assets under management in the United States. So again, 1/3 of the full professionally managed assets in the United States are managed with an ESG objective. Again, that includes impact investing. So again, that is huge and growing. So who is driving this growth? Why is there so much interest? Is the changes of labor, is it coming from up, or is it a grassroots thing? Well, it turns out every stakeholder, corporations, management, global organizations, and investors themselves, the institutional and what we call retail or individual investors, are all interested in ESG investing. And that's partly because somewhere else in the world of management and finance, there's this movement from shareholder theory, which says businesses, their only objective, their primary objective should be increasing profits and maximizing shareholder value. And there's a movement away from that to what we call stakeholder theory. So stakeholder theory says, well, yeah, shareholders are important, but other stakeholders are also important. And Alex Edmans, one of my favorite young academics in this field, says a responsible business actually should create profit, and it does create profits through creating value for society. So I find this very interesting because, again, this is not only an academic framework or an academic claim. It actually is obvious that many organizations and also corporations are saying similar things. The CFA Institute calls this purposeful capitalism. We're basically claiming that investment industry becomes more professional, ethical, and client-centric. And client is the society, so it makes sense to put the value creation for society in the center of everything. And again, this is not only coming from these organizations, it's coming from the businesses themselves. Business Roundtable, an association of CEOs of the largest firms, some of the largest firms in the United States, and they're famous for their principles of corporate governance, which were initially established to protect the shareholders' interests. And they've been issuing those principles every year since 1978, and they've been endorsing shareholder primacy since then until 2019. They released a very important letter, and that letter, labeled a redefinition of the statement on the purpose of a corporation. They said, no, we're moving away from shareholder primacy And we're moving towards a commitment to all stakeholders, to our customers, employees, suppliers, communities, and shareholders. So they're not forgetting their shareholders, but they're basically acknowledging that every one of these stakeholders are important. What else is happening? BlackRock, world's largest asset manager, is saying that sustainability is going to be their new standard of investing. It's not going to be a flavor of investing for them. It's going to be the center mode, operating mode for them. And they set this out in their letter to CEOs and clients at the beginning of 2020. This is a global movement, and it's not stopping. UN, United Nations, led the Principles of Responsible Investing initiative in 2006. And these were initially voluntary and aspirational set of principles, 6 of them, that many signatories actually have signed on since 2006. And let me just give an example of one of those 6 principles. We will incorporate ESG issues into investment analysis and decision-making processes. So as of end of 2020, more than 3,000 asset owners, asset managers have become signatories of this PRI, and they're managing $103 trillion of assets globally. Well, globally, there's already around $110 trillion assets managed. So you can imagine that pretty much all the significant large investors are signatories to PRI. And even though it says voluntary, there's an accountability aspect to this, because they don't get to maintain their signatory status unless they actually follow these principles. And we all know that those principles are linked to these United Nations Sustainable Development Goals that were formalized in 2015. And these 17 goals are very important. Why? Because impact investors are looking at these, they're targeting these. They're very purposeful in their investments. So we should understand the alignment between these sustainable development goals and those principles of responsible investing. And as a matter of fact, PRI, by looking at these 17 goals and all those 6 principles in the principles of responsible investing, and they identified 10 investment themes for impact investment only. And of these 10 themes, you would see that some of them are purely environmentally focused, the green ones here, the energy efficiency, renewable, sustainable agriculture and forestry, but also social goals, social themes as well. And you see affordable housing, education, health, inclusive finance there. So in other words, these impact investment themes help us map the framework or map the world between the investors and the enterprises that they would be interested in investing. I said very good things, obviously, so far about impact investing. One important aspect is measuring. It is not an easy task. And actually, on the public domain, that's one of the largest criticisms. It's hard to define these ESG criteria, and it's hard to measure them. And different companies that try to measure this disagree a lot with each other. You see the FTSE and MSCI, 2 very important rating companies and financial service providers, their ratings are all over the place. They don't agree with one another at all. But this is in the public domain. You would see that private impact investors do their own due diligence using those frameworks that I mentioned to you, the Sustainable Development Goals and the Global Impact Investing Network's impact reporting and investment standards. So that's why, as enterprises, we should understand how the impact investors are measuring our impact, our potential impact, and we should recognize the significance of these different frameworks, and probably not worry so much about the criticism for those ratings for the ESG of the public companies. So private investment domain is a very different domain. Now, before I end my thoughts on this very important topic, I'd like to share some numbers with you, why we should be very optimistic, especially Global Link's Impact Investment Forum. the nature of your organization and where you are focusing on right now, that is very important. Geographically speaking, especially. Why? You see the results of 2 surveys that the CFA Institute actually carried out among a large group of retail investors. And make no mistake, the interest of retail investors in these ESG strategies are largest, or were largest, in India in 2018. And they're still the largest in India. Still, I mean, it's unbelievable. It's 100%. All of the retail investors that they surveyed in India said they either currently employ ESG strategies or are interested in employing ESG strategies. So the interest towards this version of investing is largest in emerging markets, and India is leading the pack there. And what else is important? Well, the new generation is driving this change. The millennials and Gen X's, they are the ones who are really pushing this investment growth towards ESG investing. And again, impact is a flavor of that. So just remember that. So again, you see that huge interest. And this is not only interest, this is those already employing ESG strategies. So of this very young cohort of investors, almost 20% of them are already investing with an ESG objective in mind, and that's not it. What do they expect from ESG? And again, I think this chart is very meaningful because the dual objective. Remember, what separates impact investing from other types of investing is that the dual objective is very, very strong with them. And you can see that the dual objective is already very high here in this group. And again, if you add the blue, who really care about the impact, a majority of the impact investors or ESG investors do care about their non-financial impact of their investments. Again, another insight from the same survey, and again, putting India up there at the very top. Would you be willing to give up some return for an investment strategy that meets your values-based objectives? So in other words, if you are an investor who cares about values, or if you're a dual objective investor, are you okay with giving up some return? 91% of the both retail and institutional investors in India are okay with it, which again agrees with the findings of the research. So below market returns are there for many venture capital or private equity impact investors, but they're okay with it. They're okay to sacrifice some return because they care a lot about these value-based objectives. So I'm going to end my words with this kind of very simple chart that was illustrated in a paper that I read with interest in the Financial Analyst Journal. So impact investing has these dual objectives, right? Generating financial returns and generating positive impact. And if you think about these two objectives, philanthropists don't care so much about positive returns. So they're on this side. They want to generate positive impact, and they're okay with no financial returns at all, or negative financial returns, right? Now, traditional investment really doesn't care about having a positive impact. So they want to be on the right-hand side here to generate positive financial returns, but especially if they don't care about it, they may actually have profitable investments with negative impact. Now, how great is impact investing, right? It's really in the sweet spot of this diagram, which is really generating positive financial returns for their investors, and at the same time generating a positive impact for the rest of the world. And I'm very happy that the world is moving towards this, and this really is now defining the future of the investment world. So thank you for listening to me and letting me share my thoughts and my passion on this topic with you. I'd be happy to field any questions if I can in any way that I can. Thank you so much. Right, I'm seeing some questions. Professor Sharmista is asking, since retail investors in India are so enthusiastic, did you come across smaller enterprises engaging or intending to engage in ESG? Not in that research, but the G network has data on the size of not the enterprises, but of the investors. And it is true that in emerging markets, the size of investments and the size of investors are relatively smaller. And again, the G network has a wealth of data that can be scoured and explored to understand the motivations and the characteristics of the impact investors in emerging markets. But yes, I would think that the size of those investors smaller lends itself to being able to reach out to smaller enterprises and engaging with those smaller enterprises with an impact goal. Absolutely.
Thank you, Professor Koray. There were so many comments, insightful, enriching, helpful. So the chat box is filled with comments and thank yous to all who you have created an impact upon. There are professors, there are students, and I'm sure that will go a long way. But before we go on, I would definitely open the question to the floor for any other questions that may have come up. I find there's another question that, do you see the situation where impact investors from developed countries are looking at India, given that Indian market is so fertile, if I may use the word, for impact investment?
Yes, that actually was several of the things that I had to leave out in terms of all these data that I shared with you, is that the geographic location of the investors are actually very widely dispersed around the globe. And if you recall, the impact management project says one of the objectives is to help grow new and underserved markets. And many investors on the developed side of the world are really looking at the emerging markets with their objective of aligning themselves with the SDGs, the UN SDGs. And this is true for both environmental focused ones, as well as those who have a social goal, social objective. One example that I can give just off the top of my head is NatureVest, a venture capital effectively, but they have a pure focus with environmental goals. And yes, they have some investments here in the United States, but they have investments in other parts of the world, in Africa, in Asia again. So they don't really feel attached to the geographic location they are in. They definitely have an interest in emerging markets, including India. Acumen Fund, another example that I can think of right now. Acumen is probably one of the better examples, because those 4 dimensions that the social the impact management project proposes, they probably check all those four with their, not with their size, they're smaller compared to the others, but with their intention to engage, with their intention to provide flexible capital. Acumen is definitely there as well.
Thank you so much, sir. There is another question from my colleague, Orijita Dotto, whom you have met earlier virtually. In the developed countries, do you find any strong presence of regulation with respect to impact investors?
This is a really excellent question, Professor Dutta. So regulation is one of the concerns of the investors actually right now. It's not up there, but there is some uncertainty around this. And especially in developed markets where regulation can be a little, more, sometimes a little less, sometimes we never get it right. You can argue that, for instance, last year, the US SEC had a proposal about, or actually the Department of Labor had a proposal, but the US SEC got involved as well, for almost banning ESG investments in retirement plans, what's called the individual retirement accounts in the United States. That caused a lot of concern, not from the investors' perspective only, also from the institutional organizations. There were so many comments, like 97% of the comments that they sent to the Department of Labor during the comment collection period, they were all negative. Don't do this. I mean, this is the future of investing. People want to invest in these funds. Don't do something like this. And finally, they backed out. And just a month ago, they said that ESG investing can actually have pecuniary benefits. What does that mean? That means it doesn't necessarily disagree with the fiduciary duty of the investment organizations on behalf of the asset owners. And it really is not necessarily detrimental to financial performance as well. It actually, in the long run, in sustainability of this world, they may actually improve the financial performance. So they acknowledge this, and they just removed all the reference to ESG investing in their final version of the rule that they released. So yes, regulation is a risk. That's an excellent observation, Professor Dutta. But I think investors are leading the way so that regulators are looking at this more carefully and actually respecting the will of the investors as well as the investment organizations. All right, I see a question about how the market for impact investment is measured. That is such an excellent question. And I would be amiss if I try to explain it to you right now, but please look at the Global Impact Investment Network's most recent annual impact investors survey. They have like 4 pages there that they explain how they size the market, because sizing the market is difficult. It's not, you can't just survey hundreds of impact investors and rely on the response rate of that survey. So they have a very thorough methodology, and it's explained in that work. Actually, I think I do have on my slide here. Yes, the Global Impact Investing Network is the GIIN.org. On their website, they have an enormous amount of information that you can find on this topic, but an excellent question. Any specific example of status of impact investment in the area of social security? I'll be honest with you, nothing really comes to my mind specifically, but clearly the Social Security aligns well with the the Sustainable Development Goals that UN has, and the market investment market map that PRI has created. So I'm sure you would find examples on that, again, either on the GENE website, which has many examples of success stories, or other resources that you can see up here. Do third world countries serve as a breeding ground for impact investing by the developed nations? That's a very insightful question. Again, I don't know if the breeding ground is the right word for it, but if you remember this the impact management project's 4 dimensions of how these impact investors can contribute, you would see that one of them is creating or growing new and underserved markets. Now, many of the, I wouldn't call them third world countries, but developing countries or frontier countries, they are underserved in many ways, and their financial resources are not at the level of the developed nations. So yes, so there's a significant interest in those parts of the world. Yes, so I'd be happy to definitely share these links to these resources with the GLIIF, so that they can share with the attendees. Dr. Koray, that's on. I'd be happy to do that.
There was a question here.
Do you think governance and regulation is correlated and one is important for the other to safeguard stakeholder interest? Well, I'm not sure about the correlation, but governance, yes, you see that in some parts of the world, the regulation is almost dictating governance, right? They're helping sort of corporations by setting quotas and doing other types of things. That actually is a good observation. But at the same time, governance should be an internal objective as well, right? I mean, that's why, when Principles of Corporate Governance was initially released in 1978 by these CEOs, that created a real impact. It wouldn't have created the same impact if, the US federal government has said that you're supposed to do this, this, and this. And actually, interestingly, sometimes those types of regulations can create a little bit of a challenge or resistance. So when it's grassroots, I see that governance initiatives actually become more successful. But definitely, stakeholder interests should be central. Absolutely. What's this last question? I want to benefit. I don't know what. Benefit.
No, that is for the whole program, actually.
Oh, sorry.
That she's talking about the whole program.
Got it.
Thank you so much, Professor Koray. And I think before we go over to the formal vote of thanks, with which our core team member, Mr. Majumdar, would like to present, we would request all to please keep your videos on. And Professor Koray, if